Hey guys, Skylar here. Just wanted to put out a quick webinar to talk about the market conditions we're in right now and kind of the broader economy. I know there's been a lot of concern about real estate and really all asset classes with the Fed hiking rates so much. So just want to take a quick overview of all of that and give you Upwell's position on the future and how we are basically hedging ourselves and preparing. So let's just dive right in. The word recession is getting thrown around a lot these days. I think we probably are in a recession, although it's a strange one because it is an inflationary recession and we're not really seeing um, unemployment rise. But we are definitely in very unusual times. We haven't seen the US stocks and bond returns this low at the same time many times throughout history. And the few times we have seen that, it's been associated with a big devaluing of the US dollar. So the inflation we're experiencing right now is historic by just about any standard. So you might think it's a great time to invest in the stock market considering how low it is, but Vanguard is actually projecting 4.1 to 6.1% annualized nominal returns for US stocks over the next decade. Bear in mind that nominal does not account for inflation, so we're at like 7.5%. As of today, these are negative returns in real terms. So the stock market is not really looking that great for the foreseeable future, especially if you're interested in yield or dividends. It's yielding the S&P 500 is yielding 1.77% right now, which is low by historical standards. In fact, it's about as low as it gets over the last 150 years or so. This all, of course, like I said, comes back to inflation. You can see in the federal funds rate up top that in 2020 they basically dropped into zero, making borrowing effectively free. While in the chart below, the M2 money supply, you can see they raised the amount of liquidity in the system to all-time highs. Pretty much went vertical for a minute there. And they spun the wheel way too far in the direction of easing financial conditions in the economy. Now they have to spin the wheel in the other direction. So they're raising the federal funds rate, and we have started what's called a federal funds rate hiking cycle. This chart is showing previous historical hiking cycles, and what you'll notice, I've added this dashed yellow line to kind of show where we are today because this chart was a little bit old. But what you'll notice is that we have raised rates higher than in most previous cycles. We've also gotten there faster. I think this just speaks to the urgency that the Fed has right now for reducing inflation. But it's good to remember that these hiking cycles don't last forever, and we're already kind of getting to a point where we're passing the high points of most previous cycles. And so the average hiking cycle over the last 30 years has been about 2.18 years, and we're about 8 months into this one. So I don't really want to try to guess too accurately how long we think this cycle will be. I think it could easily be another 6 months or even a year. It depends how much they slow the size of these rate hikes, how much time they put between them. But right now, you can see on the right of both of these charts that it's spiking really fast. So they're trying to get this under control really quickly, and I think they want to get it under control quickly and then probably stop. They're not going to advertise that, of course, because they want to see things slow down in the economy and in the markets and in speculation and all of that stuff before they give us any good news. But what typically happens is they raise rates pretty aggressively. Then they get to a point where they flatline. They stop raising them because basically the economy is getting a little rickety under the pressure of the higher cost of capital. And so you can see in the lower chart that there's usually a period where they freeze. That's usually around 8 months or so. And then eventually they just capitulate and start lowering rates again because they have to come back in to basically save the economy because things start getting really bad and sort of spiraling in the wrong direction. So if you ask the Board of Governors at the Federal Reserve what the long-term federal funds rate will be, you'll see it on that blue dot on the right of the screen. They assume that by January 2027, it's going to be back down to 2.5%. But on the left hand of the screen, you can see sort of January of 23, they're assuming a little bit above 4%. In January of 24, they're assuming closer to 5%. And then it starts trailing back down. So I think this just speaks to the fact that, it's not going to go up forever. You got to zoom out, take a long view. And I think there's a lot to be said for investing in real estate and just holding long enough to kind of get through the storm. You don't want to have to sell in January of 2024. So just get the type of financing that gets you past all this and towards the later end of this chart. And I think there's, the reason they think that Fed rate will come back down in the future is because inflation is starting to come down. They're having an effect. You can see it's hard to believe, but in January in 2021, inflation was only 1.4%. It feels like so long ago that we weren't talking about inflation. But as you can see here, June of this year was most likely the high point. And if you look at June forward to October, it looks a lot like June backwards to February, which says to me that at least roughly the inflation seems to be winding down at a similar pace to how it wound up. So I suspect, and this is kind of rough and we could hit snags along the way, but I suspect if you counted months back from June to, January, February of last year, so call it 12, 18, 12, 18 months, that's probably about how long it's going to take from June of this year to get inflation back down. Now, like I said, that's a very rough estimate. We could hit snags along the way, or it could accelerate. But the good news is we're moving in the right direction. And listen, the Fed doesn't want to raise interest rates forever because, well, there's a lot of national debt. A lot of people don't realize this, but when Fed fund rates go up, it increases the debt burden of the federal government. So back in the 70s, the Fed was able to raise rates up into the teens, and that's because the national debt was so low. It was like $3 trillion. Today, it's $31 trillion. And there are already projections that, 30 years from now, net interest costs will account for 40% of federal revenues. So imagine a world in which 40% of the taxes collected by the U.S. government go to paying interest on its debt. That's not even paying down the debt. And that's this money that can't go to services like Social Security, healthcare, what have you. So, the Fed does have skin in the game, and they don't want to bankrupt the U.S. government. So I think one of the reasons they're raising rates so quickly is so that they can get inflation under control. And they're raising them quickly for the express purpose so that they can lower them again, so that the U.S. Debt doesn't have to as refi into higher interest rate debt. They don't want too much of that to happen. So, and I also just want to point out that interest rates aren't the only thing that impact the value of real estate. Like, I know interest rates are going up right now. We're seeing in the housing market, things are getting a little wobbly, even maybe dipping here and there. But over the long run, we as investors should always try to zoom out and just realize that interest rates go up, interest rates go down. But in the long run, the average home value has gone up almost 16x since 1971. And that's just, the average home value. If you bought in a really smart location and at a good price, you obviously massively outperform that. I think it's also just good to keep in mind that if we are in a recession or we are going into one now, these don't last forever, right? The typical recession is less than 2 years. And, there are opportunities in every recession. A lot of great fortunes are made for the people who invest through them. Doesn't mean there's something you should look forward to or hope for, because they're painful and they're very unfair. But as investors, we should always be thinking about how we can be opportunistic in tough times. So with that backdrop, I'd like to just highlight what I think are the 5 steps to de-risking in multifamily. I'll just go through those one at a time. Low leverage. I think during these, recessionary times when things could be looking a little tough in the future, you want to borrow less money and put more money down. By putting more money down, you're basically reducing your debt expense, which means that, if your rents don't go up as fast as you thought they would, or if vacancy becomes a little bit more of an issue than you projected, you're okay. You're not in the red. You're still in the green because you have such lower expenses, basically, from the beginning. 2, you want to lock in a fixed rate. A floating interest rate can sometimes work to your advantage because, like I said, if the interest rates start coming down in the next 18 months or 2 years, that can work to your advantage. But you don't really want to be speculating on what the Fed is going to do next, because the reality is no one knows. And there are plenty of historical events that may unfold over the next few years that make higher rates stick around longer than we expected or go higher than we expected. So what you want to do is lock in a fixed rate so you know your future and you can basically underwrite for that future and make sure you don't have any surprises down the road. Like I've been saying, I think long-term is the way to go. There's always short-term volatility, especially with interest rates. But, like I said, real estate over the long run tends to appreciate, especially if you do a really smart job with your purchasing at a good price in a good market. And we think right now 5 years is a great hold period to just come out the other side of this storm or kind of shaky financial conditions that we seem to be in right now. Number four, you want to invest in strong markets. So real estate is great, but it doesn't mean that every single piece of real estate is a good deal or a smart investment the same way. Not every single company listed on the stock market is a good investment. You want to find really strong markets. These green states are states that are actually growing in population, and the red states are ones that are shrinking. So you want states that have good weather, great tax incentives for both individuals and businesses. You want a growing base of employers and growing population. So if you could find these growing states, and within those states, find the submarkets that are really driving that growth, those are great places to park some capital. And then you want high income tenants. I think there's a little bit of a flight to higher quality assets right now, and I think that's well warranted, because if you're in that sort of C class where you've got tenants who are living paycheck to paycheck, the danger, of course, is that if they get laid off, they don't really have any buffer or cushion, right? These are, again, people living from paycheck to paycheck. So I think right now is a great time to invest in properties that have renters by choice, people who could probably buy a house if they really wanted one, but they don't right now because they're young and they just don't really want the headaches of, having to fix roofs and leaks. And you also get some empty nesters, people who have a lot of money, but they're sick of the house and they want to move into a kind of resort quality multifamily property where they can play pickleball and go swimming in the pool and all that good stuff, have a home gym, or a gym that they have access to. So we're looking for Class B and Class A properties going forward in this condition. And actually, we have one right now. This is a property that I think is still available, might still be available for investing in. It's called Banks at Bridgewater. It's in Myrtle Beach, South Carolina, which is a great market. We've got 60% loan to LTV, loan to value on this one, which means we put 40% down, so very low leverage. It's a fixed interest rate coming in around 5.1%, so we don't have to worry about that moving on us. It's going to be a 5-year hold, like we said, so that we can hopefully sell it in 5 years in some really good conditions for a sale. Again, Myrtle Beach, it's a Class A institutional grade multifamily, so you're going to get that great tenant base that I just mentioned, people who are kind of renters by choice. It was basically purchased substantially below replacement cost. We got a big discount on it because of the cost of capital right now and the rising interest rates, which is great. So got it around $260 per door, and its replacement cost is around $310 per door. So got it at a great price. It's got a 60% break even occupancy, which means it can be 40% vacant and we don't go into the red on cash flow, which is just ridiculously conservative, actually. We also love that this has a 2-year developer warranty, which basically means we're not going to have any major CapEx expenses for 2 years, because anything that goes wrong has to be covered by the developer. Obviously, repairs and maintenance are also going to be very low because, well, there's been no wear and tear on it whatsoever. It's a brand new building. It's just getting tenanted right now. So we like the fact that this is going to have a really low expenses for the foreseeable future, especially in a rising inflation environment, because expenses can kind of really hurt you during times of inflation. For investors, this is going to be a 7% preferred return, and a 1.7 to 2.1 equity multiple. So you can look at this as a way to double or near double your money in a 5-year hold period. Obviously, that is going to massively outperform the Vanguard S&P 500 projections, and we think this is just a great place to park capital, and we're parking a lot of it ourselves there. So if you're interested in this deal, reach out to me yesterday. By the time I put this this slideshow out, it will most likely will be oversubscribed and closed. We may even wind up having to send some people's money back because it just filled up. But just on the off chance that maybe a spot fills up, let me know immediately. If you can't make this one, or if it is closed up, our apologies, but we are going to have more deals like this, deals with similar characteristics in the future. Every deal is kind of unique, so it's not going to be the exact same, but our basic investing philosophy will apply to all our deals going forward. So please feel free to reach out to me by email or phone. I'd love to talk about this deal and future deals, or just your investing goals, broadly speaking, anytime. Thanks so much for tuning in, and we will see you next time.